Today, let's talk about another fundamental stock to add to your diversified and long-term stock portfolio. That is Zoetis, ticker ZTS. Zoetis is the world's largest animal health company, producing vaccines and medications for pet and livestock animals. We like Zoetis for many reasons. It generated robust revenue growth, growing on average at 10% annually over the past 5 years. It has high profit margins, with the last year's operating margin at 36%. It also generated strong cash flow. Zoetis is also a clear market leader as #1 across key categories. It has 70 years of long track record and stability, outperforming S&P 500 and Nasdaq over the past 5 years. Zoetis is recession resistant. It is also internationally diversified, generating almost half of its revenue outside of the US and has presence over 100 countries. Welcome to SAIFSI, Stocks and Investments for Serious Investors. At SAIFSI, our mission is simple: discover, analyze, and monitor solid companies for serious and long-term stock investors. We are not investment advisors. We are simply sharing our own research as individual investors, leveraging our experience in investment banking, strategy consulting, CFA background, and MBAs from top and Ivy League business schools. If you like what we do, follow us and subscribe to our channel. Today, we'll discuss 3 things about the company. Number 1, what they do. We'll look at the company's business model and strategy, its competitors, and its historical performance. Number 2, what we like about the company, including industry trends that benefit the company, its competitive advantages, and peer analysis. Number 3, when to buy the stock. We'll look at the company's share price trajectory and historical valuation. We'll look at analyst ratings and target price. And given all these analyses, our point of view on when to buy the stock.
Hi, I'm your other co-host for this presentation. Basically, as serious long-term investors, we believe having a strong foundational understanding of the company is essential in making these investment decisions. We are here to help you with that and also share our point of view on what we believe is a right entry point for the stock.
Awesome, let's get started.
So, what does Zoetis do?
Zoetis might not be a household name, but if you are dog cat parents, you probably know brands Simparica, Trio, and Apoquel. When your dogs or cats are sick, and you know how expensive these medications are. Well, Zoetis is the company behind these pet medications. As a matter of fact, Zoetis develops, produces, and sells prescription medication and vaccines for both pets and livestock animals such as cattle, sheep, chicken, etc. Prescription is the keyword here. Like human drugs, they require regulatory approvals, and you can only get them from doctors, in this case vets. Now, we talked about Zoetis as the world's largest animal health company. Just to get a sense of how big they are, in 2021, they made about $8 billion in revenues. 60% of that $8 billion came from pets, and 40% came from livestock animals. Zoetis is also a very international company with more than almost half of its revenue coming from outside of the US.
I think this is genuinely an internationally diversified company. Just reflecting on other companies in S&P 500, only a handful of large such companies with this type of magnitude and scale comes to mind, like the Microsofts or Amazons, Netflix, and Salesforce. Very few. So for investors looking to diversify their portfolios with international exposure, they don't need to necessarily find a Chinese company, Indian company, or a Brazilian company. I think Zoetis does it for you.
Zoetis is impressive because it's innovating across the continuum of animal healthcare. Just think about how human healthcare is done. You need to predict the diseases, prevent them, detect them, and then eventually treat them. Zoetis offers products that covers the full value chain of animal healthcare. And when it comes to predict, genetic analysis. When it comes to prevent, vaccines, which is one of Zoetis' core categories. To detect diseases, Zoetis offers diagnostic equipment as well as data analytics and sensors. Finally, to treat diseases, Zoetis offers prescription medicines, which is also another core category of Zoetis. Zoetis benefits from a very diverse product portfolio. Its top 10 products only account for less than half of its total revenue. Number two, it has a broad portfolio with 300 product lines across 8 species. These include cats, dogs, cows, sheep, pigs, chicken, fish, and horses. Number three, Zoetis' leading brands include 14 blockbusters, which means brands that generate 100 million plus revenue a year. Looking across the animal health industry, only around 42 brands that can generate 100 million plus revenue a year, and Zoetis account for 1/3 of those. Number four, Zoetis' product portfolio is very durable. Looking at its top 24 product lines, they have average market life of 30 years. Number five, Zoetis doesn't just stop there banking on existing products. It continues to innovate. As a matter of fact, over the past 5 years, it has introduced more than 1,000 new products. Zoetis has a vertically integrated business model. What it means is it handles R&D, production, and sales and distribution to its end customers directly. In terms of R&D, Zoetis has an army of 1,300 R&D employees. That is around 10% of its total workforce. It also partners with the world's top education institutions in animal healthcare. In terms of production, Zoetis has 30 manufacturing facilities globally, including the US, Europe, as well as fast-growing emerging markets like China and Latin America. In terms of sales and distribution, Zoetis has market presence in 100 plus countries, and 45 countries they have direct access. What it means is they have boots on the ground, sales force that work directly in the 45 countries and provide their customers consulting and value-added services on the ground. Their customers, of course, include vets and distributors, livestock farmers, and at the end of the day, the pet owners.
I think what's really impressive is that in spite of owning and having a vertically integrated business model all the way from R&D all the way through distribution, they do it with a very effective profit margin of 36%, and they've been consistently in that high profit margin for the last 5 years. So it's very impressive. The only other big company in S&P 500 that comes to mind is Tesla, that owns everything from engineering, R&D, all the way to distribution. They cut out the dealership model, for example. So I think in that way, Zoetis is doing a great job being both efficient and effective. And also looking just at its manufacturing facilities, they are globally diverse. They have manufacturing in North America, in South America, in Europe and Asia, and of course the Australia or the APAC, Asia Pacific. So they are very well hedged when it comes to R&D in this type of globally risky type of environment.
Zoetis has been around the block for more than 7 decades. It started in 1950 as part of Pfizer, as we all know, a human drug company. Zoetis was spun off Pfizer in 2013 and became a standalone public company. From 2015 to 2022, after it spun off, Zoetis made 15 acquisitions across products and geographies, including a $2 billion acquisition into the diagnostic device space.
As part of our own research during the point of investing in this stock, one important question that we really reflected on was, why did Pfizer spin Zoetis as a separate company. So, as we understand, Pfizer had to manage its overall debt and had to invest in its main focus area, which is the human drug. So, it wanted to raise capital. So, it also made sense because of few other reasons. The regulatory regimes or the expertise that is required for human healthcare is vastly different from that of animal healthcare. When you think of distribution channels, one is via the typical human related interface, the other one is through the vet and welfare and animal health agencies. Also, the R&D and manufacturing processes are very different for human versus animal healthcare. More importantly, it also requires a level of management bandwidth that had to deal with both managing a human pharmaceutical and drug business versus that of animal healthcare. For all these reasons, it makes perfect sense why Pfizer has decided to spin off Zoetis. Since Zoetis has been an independent publicly traded company, as we talked about, it made 15 plus acquisitions, but I think like what it did very intelligently was it made very selective use of its capital and executed its strategy to perfection. So since these 15 acquisitions over the last 10 years, Zoetis stock has outperformed Pfizer stock. So it delivered 6 times more in share return compared to that of Pfizer.
Next, let's take a look at Zoetis competitors. We think about it in three main categories. First, the core and traditional segments of Zoetis, which is medications and vaccines. Second, it's the emerging categories of Zoetis. Think about genetics and diagnostic devices. The third bucket is the generic drugs. Just like human drugs, animal drugs also face generic competition. Now, for the first category of competitors, there are three main ones here, including Merck Animal Health, BI, and Elanco. However, we think they all lack the scale and the focus that Zoetis has. For example, Merck Animal Healthcare is part of Merck, a big US human drug company. BI is a European human drug company as well, and it has a animal health division that generates around 4.5 billion revenue, which is around half of Zoetis. Thirdly, Elanco, it is independent. Like Zoetis, it got spun off from Eli Lilly, and now Elanco generates 3 billion of revenue. Again, compared to Zoetis' 8 billion revenue, it's a relatively small player. And in this industry, scale matters a lot. The sub-markets are highly fragmented across countries. You have to have the global scale to consolidate demands globally in order to make your infrastructure investments in R&D, regulatory approvals, and sales force worth it, and at the same time make it profitable. Zoetis is able to do that. The second category competitors in the emerging segment, we include IDEX and Heska here. Both are much smaller player than Zoetis. The third category, which is generic drugs, like human drugs, Zoetis prescription patent-protected drugs face competition from cheaper Me Too versions when it comes off patent. But in Zoetis 10K, it actually says there is no large, well-capitalized company focused on generic animal health products that exists as a global competitor in the industry. In other words, Zoetis sees generic drug competition as quite low. We also look at Zoetis' historical financial performance over the past 5 years to get a sense on how fast they grow, how profitable they are, and their free cash flow profile. The highlights here are solid top-line growth, expanding margin, and robust cash flow generation. In terms of revenue growth, Zoetis generate average annual revenue growth of 10% in the past 5 years. In terms of profitability, Zoetis' operating margin was 36% in 2021. To put in perspective, it is higher than companies like Apple and Google. The better thing is the operating margin actually expanded 6 percentage points from 2016 to 2021.
I guess just want to reflect on two items here. In terms of revenue, given Zoetis is a 70-year-old company, just the fact that it is still growing at double-digit revenue growth, 10% annual CAGR over the last 5 years is quite impressive in and by itself, while maintaining its high operating margin. The second point I want to emphasize here is its free cash flow. In this environment, free cash flow is a very important metric. So Zoetis has consistently generated free cash flow of 13 to 18% as a percentage of the top line revenue over the last 5 years. What that means is for every $100 it made in 2021, it was able to generate $18 of that in cash, which it could use to redeploy in its own capital in R&D or to return that back to shareholders. All right, now that we talked about what the company does, let's move on to the second section, what we like.
We like Zoetis has a large addressable market with ample of growth opportunities. The total pie here, or the total addressable market, is above $40 billion. Think about Zoetis' revenue, which is $8 billion. That means it only captures around 20% of the total market. In other words, 80% of growth opportunities here. So the addressable markets can be looked at in two segments. The first is your traditional segment, which is medicine, vaccines, etc., growing at 4 to 6% annually. The second segment is the expanding segment, including diagnostics, biodevices, genetics, which is growing at double-digit annual growth.
It's also interesting how Zoetis has made a deliberate M&A effort since its IPO 10 years ago. The majority of the 15 plus acquisitions that Zoetis has made has been in this expanding space.
The animal health industry is big and growing, so it's a very attractive market and is supported by quite a few sustainable growth drivers. The first one being growing global populations. In addition to that, the rising middle class as household income grows. As population and income grows, people tend to adopt more pets, so higher pet ownership. And people tend to spend more time with the pets and care about their well-being, or in other words, the increasing humanization of pets. And of course, people need to feed themselves, and it's very typical as people's income increases, they tend to consume more protein or meat. Zoetis operates in the attractive animal health market with sustainable growth drivers. We also say that its business is very recession resistant. During COVID time, people adopted more pets in the past 2 years, and this show up in Zoetis' revenue breakdown as well. Look at the pet segment as a percentage of total revenue for Zoetis. It increased to 60% in 2021. That compared to 49% in 2019 and 35% in 2013. Why does it matter? Because the pet segment has proven to be recession resistant during the 08-09 financial crisis. As Zoetis CEO pointed out, 86% of the consumers would spend whatever they need to care for their pets. This is especially true for younger consumers like Gen Z and millennials. They treat their pets as families. And again, going back to the point of humanization of pets.
Sounds great. So now let's discuss what are the unique competitive advantages that Zoetis has.
course. Well, number one, Zoetis' leadership in innovation, as evidenced in more than 1,000 new products introduced in the past 5 years. Number two, direct access to customers. We talked about Zoetis as 3,800 field sales employees in 45 countries talking to customers every day. Number three, high quality manufacturing and supply chain. Think about the 30 manufacturing facilities across 45 countries. Number four, diverse global portfolio with more than 300 product offerings. Number five, track record of execution. 70 years of history and total shareholder return of 36% annually over the past 5 years. Number six, result driven with financial strength. Think about top and bottom line growth consistently over the past 5 years.
All right, so innovation is not just a buzzword. Nowadays, almost each and every company talks about their leadership in innovation. So, why don't you talk about how Zoetis excels in innovation?
Absolutely. Um, they really has built a world-class R&D machine. Just look at how much they invest every year in R&D. About half a billion. That's a lot. They also dedicated 1,300 people, or 10% of their workforce, in R&D alone. In addition, they deliberately locate their manufacturing facilities close to R&D facilities. That means they can easily deploy this first to know and fast to market strategy and react to trends and new developments quickly. While last but not least, Zoetis innovation strategies is relatively lower risk with higher return. The reason why I said it is because once they have a drug that is proven in one market for one species, they will expand this concept into new species using R&D and new regions with a different regulatory dynamics, and also create new formulas and method of delivery, say from chewable to injection, etc. So that is create once, deploy multiple times strategy.
Just to weigh in here, I think like the co-location strategy or so-called agile nowadays. I've been to Facebook campus a few years ago, and I was pretty impressed when I saw their how they co-locate people. So there is a product engineering guy, a product design, product development person, and the salesperson sharing a desk in the Facebook campus and working from there. So there's a very little short turnaround time from the time an idea is innovated to when it is taken to market. Similarly, Amazon, we have heard about the two-person pizza teams. So I think like having that kind of agile environment in a traditional drug and pharmaceutical manufacturing company, that in itself is awesome. Number two, as we talked about, the 15 plus acquisitions that Zoetis has made in the last 10 years, each of them, they've been helping their in-house R&D and innovation, and also helping Zoetis complement their in-house capabilities and expand into higher growth, higher expansion product segments such as diagnostics and genetic products.
I want to give a specific example on just how important innovation is for Zoetis. Trio, which is a chewable tablet to protect dogs from all pesticides. It is one of the two top-selling products at Zoetis, or it accounted for 800 million in sales for Zoetis, or 10% of its total revenue. Now, there is a generic product coming into the market soon to compete with Trio. If this happens at any other company, they would freak out, but not Zoetis. Now, although Zoetis management expects Trio's growth to be slowing down a little bit because of the competitor, they are also gearing up to introduce a new product soon. In fact, they already tested this new product in Europe. It is a joint pain management product for cats and dogs.
Hold on here for a second. You're saying like joint pain type of medication and product for pets or companion animals. I believe like even in human care, joint care has been hardly a category only in the last 5 years, and it is still emerging. Just the fact that Zoetis has been thinking about joint care for pets and companion animals in and by itself is an innovation.
You are absolutely right. And this market, this new joint pain market is amazing. Zoetis is expecting to generate $1 billion revenue for this joint pain product. Well, now you know how this new revenue stream would more than compensate any lost growth for the existing Trio product. And the point being, as a first mover in a new product category, Zoetis has plenty of time to build brand loyalty. By the time competitors catch up and come up with a Me Too product, Zoetis would have moved on to the next big thing. Another one of Zoetis' competitive advantage is direct access to customers. We already know Zoetis has the world's largest sales force in the animal health industry. These employees, many of them with advanced degrees, would visit and talk to customers directly and provide value-add services such as training, best practice, education, and support directly to livestock owners or vets. As a result, Zoetis is able to influence purchasing decision at the point of sales. And of course, these trusted relationship and entrenched relationship with customers is very hard to replace and replicate.
All right. Now that we did a deep dive on understanding what are the clear competitive advantages of Zoetis, including its innovation, let's switch our gears into what market leadership position that it has. So in the 8 species that Zoetis operates, it has number one market position in 4 of the 8 species, including pets, cattle, fish, and swine or pigs. Even in terms of product categories, it has number one to number three market positions. In terms of geography, it is number one in the Americas, including North America and Latin America, as well as Asia. In Europe, it also has number two or number three market positions, where we talked about BI, Boehringer Ingelheim, which is a strong competitor. In spite of that, it is a solid top three position.
We also like the fact that Zoetis consistently outperform industry growth. The metrics we look at is operational revenue growth of Zoetis. What it means is this revenue growth metric strips out currency and M&A impact. Remember, Zoetis did a lot of business out of the US and it did a lot of acquisition. So operational revenue growth is a true indicator of Zoetis' underlying organic growth. With this metrics, Zoetis is actually growing twice as much as the overall animal health market from 2017 to 2020. As part of our due diligence, we also compare Zoetis against a broader set of peers. These include traditional competitors as well as potential disruptors. Now, first, let's look at Zoetis' revenue growth. Zoetis, we already talked about its consistent revenue growth at 10% on average in the past 5 years. Only a few peers are growing faster than Zoetis. The first one being IDEXX at 13%. But keep in mind that IDEXX is a pure play diagnostic company and it's only half the size of Zoetis. The second one we want to highlight is Heska. Heska, similar to IDEXX, is also a pure play diagnostic company, and it's only a fraction of the size of Zoetis at 300 million revenue versus Zoetis $1 billion. its revenue growth is highly volatile. Instead of saying growth, it actually declined from 2017 to 2019 and only turned around in the past 2 years, probably because of higher pet ownership. Another one is Pet IQ here, growing at 36% annually. Pet IQ does three things, which makes it very different than Zoetis. It runs pet care clinics, it manufactures generic pet medications, and it distributes pet medications. It's also only a fraction of the size as Zoetis, with very volatile revenue growth. It's actually decelerating in the past 2 years. And needless to say, as a distributor, Pet IQ has a much lower profit margin versus Zoetis. Now the next one, let's look at Chewy. Chewy is a online retailer of pet products. As a first mover in the e-commerce of pet, it's growing very fast, as we can see here at 51% revenue growth. However, it's still unprofitable as of date. Next, let's look at operating margin or profitability. Here, there's no much controversy. Zoetis is just mile ahead compared to everyone else. Its average operating margin was 34%. It's 10 percentage point higher than the next highest company, which is IDEX. In conclusion, we like Zoetis a lot because of its consistent revenue growth and its high and consistent profit margin. We know we covered a ton of numbers in the prior slide and this slide. We will leave the details for you on our blog, www.saifsi.com, for reference. We just spoke about historical performance. We will quickly give you the highlight on financial projections here. Zoetis is expected to continue to grow top and bottom line according to consensus estimates. We also like the fact that Zoetis stock beat its peers. Looking at the past 5 years stock performance, Zoetis beat the peers like IDEX, PetIQ, Hesgas, who have higher revenue growth compared to itself. In the past 5 years, Zoetis returned almost 1.5 times versus IDEX 1.2 times versus PetIQ and Hesga at negative return. Similar trend here if we look at Zoetis total shareholder return, or TSR, which is nothing but assuming dividends are being reinvested. Zoetis, of course, beat its peers again here. Zoetis stock not only beat its peers, but it also clearly outperformed the market. In the past 5 years, Zoetis share price increased by 140 percentage points. That is double that of NASDAQ and triple that of S&P 500.
Now that we understand the business model, strategy, performance, and competitive advantages of this company, let's jump into the $1,000,000 question: when to buy?
To answer this question, we'll share with you a very simple framework. First, at any point of time, ask yourself, do you still believe in a company's fundamentals, meaning having conviction? This includes, does the company still hold its competitive advantages? Is it performing well financially? Are the industry trends still in favor of the company? Just like how we covered in the previous what to do and what we like section. Next, the second question we should be asking is, what do you believe is a reasonable entry point? Meaning being opportunistic. This is not just for the first time buying the stock, but also when you add to your position. Here, we'll cover the company's historical share price and valuation, its peer benchmarking and valuation, as well as analyst ratings and target price. We will use dollar cost averaging approach to time the entry point. Last but not least, you want to ask yourself, now that you believe in the company's fundamentals and have a point of view and what is the right entry point, you want to be diversified and disciplined, basically being a serious investor. This means tracking the company's, for example, key updates and ongoing performance, tracking the macroeconomic, competitive, and industry trends, as well as managing the portfolio diversification and risk. To stay up to date, please follow our blog at www.saifsi.com.
Let's take a look at Zoetis stock performance. Over the past 5 years, it has grown twice as much as that of Nasdaq. In the same time period, in the last 5 years, Nasdaq grew around 70%, whereas Zoetis grew 143%. If you look at the stock trajectory of Nasdaq versus Zoetis, more or less, Zoetis has been following the same pattern as that of Nasdaq. With the exception of the last 2 years, where Zoetis has relatively outperformed, the divergence between the two lines, the yellow and the blue line between Zoetis and Nasdaq, has increased in the last 2 years, mainly for two reasons. There has been increased pet adoption, as you all know or can imagine, during the COVID time. There is increased pet ownership. There is increased pet owners have been spending more time with their pets. And of course, there is also steady meat consumption or protein consumption. So because of those reasons, and the second reason is the acquisitions that Zoetis have made in the last 2 years were also positively perceived by the market. So you can see the divergence. The key takeaway here is right now Zoetis is at a 52-week low, giving an opportunity for investors either to start building a position or strengthening their position in Zoetis. Now let's look at Zoetis valuation using a key metric, PE ratio. It's called price to earnings. At any point of time, price to earnings denote how investors or analysts perceive the value of a company in terms of its earnings. So PE is a very important metric. That's why we are focusing on that here. If you look at Zoetis PE ratio, you can see that as of now, currently, it is trading at 27.6 times price to earnings. Comparing that to last 1 year, last 5 year, it is relatively cheaper, also relatively cheaper compared to its last 10-year PE ratio. Since Zoetis has gone IPO over 10 years ago, it also reached a all-time peak valuation in terms of PE of 49.9x, almost 50 times price to earnings. So compared to no matter what time period you look at, in the last 10 years, Zoetis is currently relatively trading at a discount of actually 22x or 22 times compared to its all-time high. So for this reason and for the reason that we discussed on the last slide, that it is trading at a 52-week low, we believe it's a relatively looking attractive to enter the market, enter Zoetis.
We also consider how Wall Street analysts look at Zoetis stock as a sense check. In terms of analyst rating, there are 15 analysts covering Zoetis stock. 13 out of the 15 analysts rated Zoetis stock as a buy, and 2 rated them as hold, and none of them said Zoetis stock is a sell. In other words, most of the analysts are quite bullish about Zoetis stock. In terms of target price analysts put out, the range of target price is $186 to $264. To put in perspective, Zoetis now is trading at $146. The key here is to look at the median analyst price, target price, which is at $225 per share, which means median analyst price represents a more than 50% upside versus current share price.
I think this is quite a bullish view that the analysts have. And if you think of the analyst ratings, these analysts cover these specific sectors. So their kind of bread and butter is doing this type of analysis on companies and its other competitors within the sector. So we can see that having like a strong buy is a good indicator of how the Wall Street is viewing Zoetis as an attractive opportunity.
Now, putting all this together, we believe Zoetis is a solid company and is now at an attractive entry point for investors for a few reasons. One, it's trading at 52-week low with the analyst share price at 50% above its current share price. However, we do take a more conservative view considering Zoetis' 10-year average PE ratio of 30 times, which translates to around $170 per share, which means we believe any share price below $170 would represent an attractive entry point for long-term and serious investors. Now, we know the market change and the company updates their financials periodically. We help you track and monitor all of these. Please visit our blog at www.saifsi.com for the latest updates. And also subscribe to our YouTube channel, SAIFSI. Thank you for joining us today. We'll continue to share our research on new investment opportunities and stocks for your long-term and diversified portfolio. Please subscribe to our YouTube channel, SAIFSI, and visit our blog at www.saifsi.com.